Hey guys, what is up and welcome back. This is Arthur here, and in this video we're going to take a look at Nike. Nike is a foot apparel brand. We can see a little description about it on MarketWatch. If you scroll down, let's see, sale of athletic footwear, apparel, accessories, equipment and services. North America, Europe, Middle East, Africa, Greater China, Asia Pacific, Latin America, global brand division, Converse, and corporate. So it has a lot of coverage, and that sums it up. So then what do we know about Nike? Current price 77. We don't look at the share price because I like to look at the company level, because the share price is just a very short-term reflection of the price. But we can see it is down from a 52-week range. The top of the range was 102. And what I checked before recording is that if you go all the way back and show this chart, look at this drop that has happened. We don't care about the chart. I'm just showing you what is possible for other companies if you find them be expensive. You just have to be patient. As you can see, Nike is down all the way from $170 all the way to $77. That's more than a 50% drop. So just keep that in mind. If you find other companies that seem expensive, you just have to wait, because these do happen. I don't know what kind of hype this was, and whether the company has fallen off, because from what I see already, it doesn't look as bad. So let's see what we can find in here. So Nike with a market cap of 114 billion, to which we will compare things because we like to do that as opposed to doing that with the share price. A beta of 1.02, so this almost exactly mimics the average movements of the market over long times. And so, okay, let's get into the financials, because those do tell amazing stories. So first of all, income statement, revenue. Revenue is up from 37.4 billion all the way to 51.4. Very nice increasing trend, an increase of 37%. And it looks like stable growth. It has sort of plateaued in the last 1 year. We're looking at 2020 to 2024. MarketWatch sometimes doesn't bring the newest set of earnings, but we'll get over that. So we are up 37% on revenue, which is fantastic. And then if we go down, we can actually look at their gross income. So that's like a sum, 44% of profit margin. That is nice. I don't know why it doesn't bring previous years, so I just gotta show you that on my sheet, which is basically the same, but I calculate more. It looks to be very steady, average of 44%. So if we go further down, our second metric here is going to be net income, which is also up from 2.5 billion to 5.7 billion, which is massive. That's like 124% increase. And it sort of is a wiggly line. 2020 was a special year, I guess, because this does seem like an outlier in terms of net income. So you want to know why that is, because the rest of the 5 years look pretty stable and pretty much in the same range. And we can see their net margin being 11%. On my sheet, we can see that it has been higher, it's been lower, average of around 11%. So we can say that is what it is. And now that we know what the average of net income is, which is about 5 billion, 0.02, we can measure that up against the company's valuation, how much the company is worth versus how much money they make in earnings. So if you divide 114.37 billion, which is the market cap, by the 5.02, which is on average what they earn in a year, you will get that the PE is 22.79. We keep forgetting putting the check marks, but 5-year revenue growth and 5-year net income growth was a check mark. And 5-year PE is an X, barely, because we are using the average, and last year's net income was actually higher than the average. So if you were to use that and you bring out a calculator and you divide 114.37 billion by 5.7 billion, you get 20.06, still technically over the 20 PE ratio that we would want to see our stock below. So it would still be over, but it's much closer and it's a better valuation. But I just like to look at a 5-year average to smoothen things out, just to get rid of any sort of outliers as much as possible. Now, next up, we can look at what I like to do, and what I suggest you do when you do your research is to look at the industry PE. How do competitors do? How those competitors are priced relative to how much money they make, and so what the median PE ratio of that industry is. And for that, we find it's 19.1, so Nike is more expensive than the competition. So that's an X there. Next up, we want to look at how well they use the money that Gap puts into the business. One metric to look at that is return on invested capital, which in this case will be 25.64%, way above the market average of 9 to 10%. We're looking for more than 10% to keep it nice and round. This is above, so that is a check mark. Very nice and smart use of the money that gets put into this company. And also, companies that have more than the market average tend to have some kind of moat that they can build upon, and that sort of becomes their own moat in a way, because they are that much more able to use cash on things that earn them a higher return, and that just keeps evolving into itself. But you have to be cautious and check into the future how much of these investment opportunities they have and how likely they are to keep that up, because after one point, meaningful investment opportunities might run out. But if a company is able to earn a higher return on its money, it just can build this snowball effect to keep them going forward. Okay, next up, back to financials, and 5-year shares outstanding. We want this going down. It's going to be in the income statement, right where you have net income, how many ways you have to divide that up between owners, the shareholders. So we have diluted shares outstanding is the one that I look at. This is going to be down, which is good, from 1.59 billion to 1.53 billion. This is a tiny 3.8% drop. It is a drop, so it's a check mark. We like to see that. It's not huge amounts of stocks being bought back, but the tendency is good. There have been some issuance of new stock, which is not good, but again, they came back and bought that back. So okay, it's not a huge decrease. I like to see a bigger decrease than this, but the tendency is good, and let's hope that they keep it this way. Now, we want to see whether that revenue growth that they have accumulated is due to them being a good company and having good management, or just bringing on more debt into the business and financing the growth via loans and debt. So the way you do that is you're going to take a look at your long-term liabilities and want to see what was the rate that those long-term liabilities grew by, and how does that compare to your revenue growth. Now, liabilities you're going to find in the balance sheet. It's not going to be written, it's not always written. Some companies have different layouts than others. This is, I think, the most standard layout. It does not have it, but the way you get it is that you take total liabilities, which is current plus long-term, and you deduct the total current liabilities. Now, if you do that, you are going to see that there will be, I can show you that it is calculated on my sheet. You can go to balance sheet, come down there, you can see this is current liabilities, total long-term liabilities, total liabilities. You take total liabilities, deduct current liabilities, you get these for each year, and you can see that. Let's see if we can bring this over to show us the trend. This has, it's not going to be, let's make that a trend line quickly, or like a change. So you can see that this is down 12.79%, which I can also reveal to you now that we have that also calculated. And the 5-year revenue growth is 37%, as you see on the first card under the graph in gold. So that is good. They managed to cut their long-term liabilities by almost 13% while still increasing revenue by 37%. So that is a big check mark. We like to see that. Now, my favorite part, free cash flow. We can go back here and bring out the third financial sheet, which is cash flow. Now, cash flow always is net operating cash flow plus minus capital expenditures. You're going to add this up, but because this is a negative number, you essentially just take the difference of these two values. You can do that for each year. On MarketWatch, you can also find that on the very bottom as free cash flow. So these would be the sums. And we have gone from 1.4 billion all the way up to 6.62. Again, 2020 being a special year, I'm not sure how much you want to factor that into growth. You could look at historic data and look back not just 5 years, but 10 years and see how free cash flow evolved over that 10-year period to see whether they have really come from the heights of 1.4 billion in previous years and did the jump to 6 billion, or whether this was sort of just an outlier and they have always been around this. From 5 years, we can see that this might not be that much of a stable, relevant information. We might focus on this one because this seems more stable, and this is not much that we can base a trend on. But we can see that the average is 4.66. It is up technically 370%, which is a massive check mark, because they managed to almost 4x. They did manage to 4x, I think it is even more than that. It is more than that. They managed to almost 5x their free cash flow. But if we take a look at even just the previous 4 years, it is still an increase of at least 10% in 4 years. So that's all right. We got to do more research on this one and look back in time what happened there. But that is good. Now that we have the 5-year average free cash flow of 4.66 billion that you can see on the top right of the 8th card, we can compare that to the long-term liabilities that we calculated here. And that way you get how many years of free cash flow on average it will take them to pay down all these debt. In the most recent year, they have $13 billion of debt. They make 4.66 billion free cash every year. So that means they would need 2.81 years to pay that down, which gives them some room to maneuver. We would want this to be below 5. So that is good. It's a check mark. And so they have room to maneuver and also to pay down the debt while doing all the other things you can do with free cash flow, which is to pay down debt, buy back shares, issue a dividend, buy other companies, and reinvest in the business. That's what you can do with free cash flow. All amazing things, and why we like free cash flow. Now, lastly, that you know the free cash flow, the average 4.66, you can get again the market cap and divide that with your free cash flow number. to get not the PE ratio, but the price to free cash flow, which will give you how many years you would have to wait, not in terms of making sales, but generating cash. So it's a different aspect. Free cash flow is harder to manipulate than net income, so I tend to trust that a lot more. And so if we take that and calculate that, it's 24.5, which is an X because it is higher than 20. We would want this to be lower than 20. But if you take a look at, if you take out your calculator and you look at the most recent year, and if you also go back to the free cash flows, let's see what the previous years were. So we scroll all the way down. So the free cash flow numbers are around 5 to 6 billion. So a bit higher than the average that we have calculated. So if you just bring out your calculator and divide 114.37 billion, which is the market cap for Nike at the moment, and you divide it by the last year's free cash flow, which is 6.62, you will get 17.27, which is within our benchmark of it being below 20. So that makes it a good idea to look into, because you would essentially, what this means is that if you buy the whole company now, you would need, with the most recent year's free cash flow number, 17.27 years to make your money back by the company making that much money and spending it on the 5 things that we mentioned you can do with the money. So it's a different way of making your money back, but you still want to have a sensible time frame to make your money back. 2 ways you can do this is that if you find a company that's sort of under price to free cash flow 20, which means that you are, if everything stays the same with the company, you will sort of make your money back as an owner in the company in less than 20 years, not just within 20 years. Or the other way that you can do is if the price to free cash flow number is higher than 20, that means you would want to have some kind of growth in this company, growing that free cash flow number. So as you go forward, the company starts making more money, and that reduces your initial free cash flow number, because all of a sudden we have sort of a 24.56 for free cash flow now. If the company was to, in the next 5 years, again double its free cash flow, it would be a 13 billion. They would be up to 13 billion. And if we divide that right now, again, the market cap divided by that sort of 13 billion, that would be a price to free cash flow of 8.8. Now this would likely be already factored into the price, and it's always a question of your assumptions of whether this really is going to happen. We don't know. If you ignore this 2020 year, the free cash flow seems sort of stable. There has been some growth. I don't know how likely it is that in the next 5 years you're going to double it. That's for everyone to decide and come up with their own assumptions. But what we can see is that if you use the very last year's, the most recent year's free cash flow, it falls below 20, which makes it a very interesting thing to look at, because you are already sort of in that green, and you just need the story to this, because we have looked at the numbers. You need the story. Will Nike stay around? What are their plans on improving some of these profit ratios? What are their other plans going forward with this business? And so you can make the picture for yourself and come up with your own assumptions, see what price Nike is worth for you. Nike is a premium brand and is a very well-known brand. If you ask people or just look around and ask them to name sports brands, they will likely name Nike. Most of them, some of them do wear Nike as well. So it is around. Will it still be around in 10, 20 years time? That's a question to ask yourself. Will this company still be doing this well or in this way? That's also a question you would have to answer. And so premium companies that have a high return on capital and companies that are well known, they have some kind of mode, deserve a premium, especially those that can grow numbers really quickly. How big of a premium on price to earnings or price to free cash flow, no one knows, but Nike at 24.5 currently price to free cash flow, and with the most recent years 8.8. I just want to divide the market cap by sort of the average of the last 4 years, which would be around 5.2. I'm guesstimating. That would still be a 22, which is not like a huge premium for Nike. So this would be very interesting to look into further, because this might be something interesting. Nike scored 7 out of 10, so this is where we're gonna leave this. Let me know of your thoughts, where you think Nike is headed, and what other companies we should look at next. Thank you for your time, and I hope to see you in another video. Bye.